Welcome to the Chesalbridge Capital Market Observations Call. I'm your host, Eric Jefferson. Today is Tuesday, April the 2nd, 2024. A lot to talk about today. Before we kick things off, though, a few quick words from our legal team. With that, we can go on ahead and begin. March ended on a great note for capital markets. We saw the S&P 500 eclipse 5,200. That was the year-end price target. A lot of asset management firms had originally published. That represents a 10% gain since the end of last year, one of the largest percentage increases in the first quarter, going all the way back to 2019. It also marks the fifth monthly gain for the index. As well, we saw in the first quarter, S&P made 22 fresh all-time new highs. That was a theme that we had talked about as well. Good to see the positive momentum continue. Dow also on the verge of eclipsing 40,000 for the first time in history. When we look at some of the drivers of performance, certainly a handful of names benefiting from that AI mania continue to thrive. The Metas and the Nvidias of the world continue to post some very strong returns, although we're realizing that's not as consistent as it was last year. Some of those companies more directly tied to China, which has seen some slowing growth, also suffered from some concerns around intensing geopolitical conflict. The Apples and the Teslas specifically have come under a great deal of pressure. As well, we see some one-off names. The Boeings of the world have had some challenges. That has been very much reflected in their stock prices. But overall, have seen market participation or breadth, the number of companies participating in gains, that has certainly continued to expand, which all else being equal, certainly viewed as a good sign. Another reason we're seeing a lot of positive energy and excitement is with respect to the outlook or expectation for interest rates to be cut. We have investors projecting about a 65% probability of that first cut taking place in June. Granted, those estimates have been pushed back relative to where they began at the beginning of the year. But I want to take a moment and just focus on why that's important. First and foremost, lower interest rates help stimulate the economy. Obviously, the faster and larger a economy is, more of a natural tailwind there exists for stocks. As well, with the Federal Reserve cutting interest rates, that in many ways signals, assuming that they've interpreted all the data correctly, victory over inflation. That obviously then has a very positive catalyst for both investor and consumer sentiment. The delay in interest rate cuts that has negatively impacted bonds throughout the first 3 months of the year, although any weakness has been overcome by a very large position we've maintained in gold that both literally and figuratively continues to shine as an investment. Although the best performing investment we've seen by far and away, cocoa, that is obviously the key ingredient in making chocolate, up over 300% over the last 3 years. The story there, heavier rainfall has actually led to more disease for those plants. Diseased plants don't produce as much product, therefore less supply on the market, putting very meaningful upward pressure on prices. Good news, you may not see that reflected in the price of a Hershey's bar today. A lot of those companies will hedge against meaningful price increases in cocoa. 2025, though, could be a very different story, as a lot of those hedges will expire and need to be reconstructed. Going back to the macro data, better than expected news on the economic front. GDP, gross domestic product, that is the measure of the size of our economy. That continued to grow at a above trend rate, 3.4%. That was slightly better than expectations. Again, long-term average there is 2%. That figure less than what it has been, but again, key difference or key piece to focus on, the economy is still growing. Analogy I like to use, if you're driving on the highway, if you go from driving 65 down to 60, you're still moving forward, you're still getting closer to your goal. Granted, you're just doing it at a slightly lower rate or pace. Additionally, on the unemployment front, mixed data there. Interestingly enough, we'll get some labor metrics this week. Key focus as we think about wage gains, that's a positive. offsetting the fact that we have seen a slight uptick in unemployment. Last month reached 3.9%. That is the highest rate that it's been in the last 2 years. Again, something to watch very, very closely, particularly as we think about how that may impact the Federal Reserve's outlook for rate cuts. Obviously, we are at the quarter end, so in the weeks ahead, we'll be putting together our traditional commentary. That's a 4 or 5 page document that will go through all of the key metrics with respect to the economy and markets, as well for any specific portfolios, putting together those standard one-pagers, talk about how they're positioned, how they're performed, as well capture any trades that we've made. So that's all for today. As always, if you have any questions, more than happy to discuss. Take care.